Just waiting another minute or so while people file into the Zoom room.
Zoom room.
I have to get my coffee in now before I start talking.
Right, chug.
Make you talk a little faster.
Can you hear me drink my coffee? Should I go on mute when I drink?
Hold on. Oh, I can't hear it when you're on mute.
The mute button works. What about now? Can you hear me drink my coffee?
Hold on. Swallow really loud. That sounds weird.
Were you able to hear that?
Like the tiniest bit, but I don't think it's like in those obnoxious ways.
Okay.
But
For
I
everyone
think
joining, that's not the subject of this webinar. We're just waiting a minute for a few more people who we know plan to attend to arrive, but I think we'll be getting started here in 30 seconds.
Yeah.
Most of the names on here are used to our, coffee time with aACE warm up. But don't go anywhere. This is going to be a good one.
How much info do you think we have to cover, Michael? Like, are we covering a lot today, or like a normal amount? A lot. Great. Buckle in, people.
All right. Well, with that, let's get started. Good morning, everyone. Thank you for joining us to learn about how aACE handles landed costs, cost of goods sold, and WIP. My name is Ashley Harker, and I'm a project manager here at aACE Software. And today you'll be hearing from Michael Bethy, a founder and the CEO. We also have Aaron Nolan here, aACEsoft's product specialist. Just a few more details. This webinar is being recorded, and after this meeting, we will send you a link so that you can download the recording. All participants are muted, but if you'd like to ask a question about what you're seeing, please do so at any time using the Q&A button at the bottom of your screen. And with that, I'd like to turn the microphone over to our presenter, Michael. You can share your screen and jump in.
Okay, thank you, Ashley. Okay, can you see my desktop?
Yes.
Yes.
Okay, so let me prepare a few disclaimers or notes over here. So let me get started. For any prospects who are watching this webinar today or a recording of this webinar in the future, this is going to be a very advanced webinar. This webinar is a follow-up to a foundational webinar where these questions were asked. And kind of interestingly enough, they actually all intertwine. So we scheduled a follow-up webinar to discuss them. But if you're brand new to the software, if you haven't used it before, this will be interesting. We're going to be talking about some really cool tools, but it's also very advanced and it might be sort of difficult to know where you are. So please keep that in mind. I'd like also everyone to keep in mind that this is still new software. aACE was released a month and a week ago on March 10th. It's April 20th today. We're still finding bugs. There's this 3-month period after a new release where we're doing lots of testing and lots of bug fixing and things. So to encounter something unexpected is expected during this phase of the software. And the customers who are currently going through the discovery and the implementation processes are aware of that and are helping us to debug this. So please keep that in mind. With that said, let's go ahead and jump right in. So we're going to be talking, a lot of what we're talking about today centers around the estimated unit cost for a product. That's this guy right here. What is it? How's it used? This is really the value that you want used when you're estimating costs for an order. Now, it could be just a sales order and you want to estimate your margins. Perhaps you compensate your salespeople based on the estimated margins to give them pricing flexibility, right? It can also be the cost that's used when the system needs like a placeholder cost. we'll talk a little bit about that later today. So that's the estimated cost rate. It is not necessarily the cost rate that is associated with a particular vendor. I don't happen to recall whether. Okay, so here we've got a couple different vendors. This is essentially their last cost, right? And so you can see here they're more expensive, but they have a lower lead time. They're much more expensive. They're much less expensive, a longer lead time. The estimated unit cost is neither of these numbers. So it's really intended for many of our customers to be kind of an accurate estimate of the cost, given a number of factors, freight being one of them, but multiple vendors being another, perhaps multiple ways of receiving the product being another. We may, in some cases, want to choose a faster form of delivery and pay more money. That could be more money to the vendor, or it could be more money to a carrier, right? So the idea here is that we've got a number that people can use to estimate a margin that is somewhat intentionally detached from the true cost that may exist for an individual transaction. Okay, so I'm going to just jump right in. We're going to create a new code so that we can start from scratch and watch data build. So 04/20/23, today's date. Test inventoried item. And I don't want people to get lost in the data, like, you know, we don't sell widgets kind of thing. So I'm just gonna leave this generic, but this could be anything that you purchase. Okay, so let's go ahead and activate this. Let me actually change the test. That looks like test 2. So that's nice and descriptive. Okay, so I left everything 0 here. Let's take this code. Let's go create purchase order. I'll use Granger. So this guy in, change my notes here. Let's do 40 units. Okay, so 40 units at $10. That'll be, these will be easy numbers to work back from. We'll put this back in March. I'll add another line here for yesterday's notes, so we're rehearsing this in case we want to, in case we get to one of our time permitting topics. Okay. Okay, so let me hit save. So what we're going to see here, I'll hit not yet, is right now the estimated unit cost is 0. We have no vendor associations just yet. Let's go ahead and open this PO. Okay, so at this moment in time, aACE learned that the estimated unit cost is 10. It's really only done when that estimated unit cost is 0. Otherwise, this might be subject to other logic. It could be your own logic where you're manually entering a value, or it could be some of the automated logic we're going to look at today. But for the very first time, aACE will learn. It also established a vendor relationship with the unit cost. So right now, these are in sync. And here's what our logs look like. Okay, cool. So easy peasy. Let's receive these goods. Constantly struggling with where to put my little cameras. Okay, new incoming shipment. Let's just say we got them on first. This portion of the demo doesn't really matter. Okay, cool. So there we go. All right. So we already talked. Let me actually move this down a little bit. So, all right, so let's say that, I mean, I just put in one receipt, but let's say the vendor sent us 3 shipments and they sent us 3 different bills, and it's a commodity item of some sort. And so the pricing isn't guaranteed. The pricing isn't based on what's the PO is. It's just kind of like, we'll send you what we have and it'll be that day's price. So I'm going to go ahead and we'll receive this second line. Well, no, we'll come back to that. Okay, 10 at, let's have this be $8. April 1st, $8. Okay, that's 1/4 of the units. All right. Let's create another purchase here. Let's make it the 7th. Let's put in 10. We'll have that one be $10. Okay. And let's create one on the 14th. All right, let's make that another 10 units. Okay. Oh, crap, I wanted to make, let's void this. I want to make that a higher unit cost. Like, getting good demos of various functionality in the system. Let's duplicate. This was going to be the 14th. I wanted to make this a pretty big number. Okay, do it right this time. Yep. All right. Now let's do one more that's really big. And we'll get to that auto update process. Let's make this for yesterday. Let's make this $20. Okay. So what we have, if we look at this now, we can see that our estimated unit cost is 10. Our unit cost, this is really the last cost for the vendor, is 20. So what this is telling us right here is if we were to go and buy it today from Grainger, the same product, the system would assume that our most likely cost is going to be 20. Now with a product like this with variable costs, we might have to change it, but that value for that vendor is going to be more accurate than that 10 that's up there. All right, so let me go here. Let's jump to our related purchase items. That's super cool. Okay, and then let's take out this guy. And this is actually a useful example. We might want to come back to this because the system has logic for what it does and doesn't do for adjusted items and adjustments. And that really will tie in with the auto update process. So anyways, if you wanted to say, now you can imagine this scenario. So if you're thinking to yourself, well, we would never have a PO like that. I promise you, many of our customers have POs just like that, especially during COVID. They're ordering things, someone's doesn't have the right stuff. They're going to do a partial shipment. The price changed. We can get you a half faster if you do this, that, or the. If that's not you, trust me, that's a lot of our customers. If that's not you for a specific vendor, then it might be you for multiple vendors. So you may have consistent pricing per vendor, but you have different vendors who have different pricing because they have different lead times. A lot of times those lead times are a function of where their warehouses are and how long it takes to get you, which is going to affect the freight cost, which is going to affect your landed cost. So if you're already lost, like I said, this is an advanced webinar. But if I do a little bit of math here, we've got 520 divided by 14. If you said based on this, just a little bit of data in the system, what's our sort of average, or purchase cost? Well, it's going to be $37. Okay, so let me see what I had next. All right. So we talked about this. We talked about, okay, so how and why the cost is used. Obviously, we've got a $37 cost because costs have been increasing. But when this code was created, which might have been a few months ago or a few years ago, someone input 10. 10 might have been the right cost at the time. It's no longer the right cost. Particularly in the case of commodities, prices are fluctuating, but nobody's sending us a new price list. Suppliers aren't sending us a price list. So the question for our customers becomes, what do we do, right? And that's where the auto update cost process comes in. It says, okay, let's look at recent purchasing activity or inventory, get to that, and let's kind of keep this moving. That is usually paired with some price logic. So if we go over here to the setup area, there's an oversight notice that says send a notice if this product is sold with a margin less than. So you can say the margin on this particular product should be 25%. And if costs are changing such that that margin gets squeezed, shows up on an order with less than 25%, can send a group a notice and then let them know that they need to maybe manually adjust the unit costs if they don't want to have the automated process, or maybe the salesperson is doing something they shouldn't, et cetera. But this sort of automated cost, you can imagine if we had put it in at 10 and we said we want a 50% margin, so we're going to sell it for 20, but now our cost is 37 because of COVID shortages. We want the system to tell somebody because we're losing a lot of money on every sale under that scenario. So that's the scenario we're going to focus on a little bit more today because it's applicable, but there are other reasons you might want this oversight notice. Okay. All right, so we have, let's say someone says, we want to have the system automatically do this for us. You can enable this preference. Update the estimated unit cost to the greater of the weighted average of current inventory or purchasing activity within the last number of days, right? So that's how we do that, okay. So if I run it right now, let's just run it right now. Okay, so it auto updated this cost rate to $13. Let's see, where is this going? Did I? Okay, so maybe that's right. Let's see.
I think it is.
520. Did I do my math wrong before? Oh,
I think
I did my math wrong before. Whatever, 37.13. Okay, good thing I don't build accounting software.
Oh man.
Good, so there's $13. We look at our logs. It says auto updated unit cost from 10 to 13 based on purchasing activity. Okay, cool. You may come to me and say, however, right now it just said total purchasing activity. You may come to me and say, well, this is oil. And the cost of oil on April 1st is irrelevant to us. We want it to be just the last X number of days. Or some of our customers will say, we just want that to be our last cost. Forget about who we purchased it from, just make our last cost. Make it our last cost. That's where in this setup, you can come in and you can put in some logic here. We want it to be based on the last 10 days. If you want it to be based on your very last cost, so that the cost that gets into the system is 20, you just make this 1 day or 0 days. I'd have to test what 0 does. It kind of depends on when you time the schedule, but that's gonna pick it up. Now you have to think about purchase dates and things too. So there's always a little bit of complexity here, but this allows you to consider a subset. So let me come down here and manually run this again. Now it's $17. And that's because, that's going to be some combination of these two. right? 1420 divided by, yeah, 17 bucks. These two were not considered. So that's how that filter works. Okay. Oh, and then let's look at the log, right? I point out the logs, not just because it's a cool demo, but also if you're charged with implementing this, you can see that there are lots of ways that this could go wrong. And so with power and with automation comes a certain level of discipline that's required. So you would not want your, let's say your purchasing team receives an offer from a supplier that they're going to give you a discount or a rebate in this one case. You would want to put that on the second line, because you don't want, if your purchasing activity for this product is driving this, you don't want that discount to lower this rate if it's a one-off. So with power comes discipline and comes responsibility. It also comes with a requirement to really learn the software and to train and practice. Okay, so let's now talk about landed cost. Let's look at one of these purchases. So you may have noticed in each of these purchases that we have this freight column here. If you put the freight in here, then incorporating that freight value into the unit cost line item code is a doable thing, because we know, like, what you're telling the system is that these 10 units cost us this amount to ship. Just consider that as part of the total cost divided by the quantity, and there we go, easy peasy. The challenge with that is that that's when landed cost is important, that's not typically how it works. So let me pull up this PO. Oftentimes when landed cost is important, we have a separate invoice that's coming from a carrier. So I'm going to make this international freight. Okay. And then they're not actually billing us for any of the goods. They're just billing us for freight. And so this is where we're going to say, yeah.
Your vendor didn't change.
Didn't?
Mm-mm.
Oh, is that a bug?
Maybe.
Huh, that's interesting. Can you note that, Aaron?
Yep.
Yep.
Already on it.
So anyways, imagine that's an international freight. They're going to give us a freight bill, and I'm going to make this really big so that the sort of the numbers that we're talking about here are obvious. So it's $1,000. This is where we say, allocate by, we'll do by value because I haven't entered weights. This is where we say use PO, because we're saying that we can't allocate by these, we can't allocate by quantity, we can't allocate by total. We don't know necessarily how many units there are that this invoice corresponds to. Was it the whole PO or was it half the PO? So this is where we're saying, here's the freight charge, and we want to use the PO as a point of reference. So that's distributes it based on the data that's in the PO. And this is a way we can get the cost. So let me go ahead and hit save. Okay, now, all right. Okay, so let's open up the inventory lot associated with this PO.
This is where it starts to get really fun, if anyone was wondering. That's the coolest stuff. I think it's the coolest stuff.
Okay, so 0420. So here we go. So right now we can see that the estimated unit cost was 10 bucks. This is what the PO was written for. We've got a little disclaimer down here, a little note the estimated cost is used until the actual unit cost is final, i.e. the related PO is closed. Right here we see estimated unit cost. This PO is still open. We're expecting a freight bill. Okay. the purchasing activity, the receiving it can be wild. But once a PO is closed, that's what's telling the system that all of this activity is now final. There's a certain degree of trust associated with it. So 10, okay, 13. Let me go ahead and open this. Okay, so this is our payables department opening the purchase. Boom, $33. Took that landed cost and it added it. So now our inventory system sees that we've got 40. It's still thinking 10, but with landed cost currently, it's 33. Again, this number may be wrong and not wrong at the same time. So imagine a scenario where you receive the goods and you don't get a bill from the vendor, and but you do get a bill from the freight company, or you haven't received the goods, but you enter the bill from the freight company. So all you have there is a unit cost for the freight. So again, you got to keep in mind that the system can't trust that a PO's information is accurate until that PO is closed, because any of these actions can happen at any time. Okay. But now, so if I run it now, it's not gonna do anything. So I'm gonna go ahead and let's close this PO. We'll see how those values shift. Okay. So we come back. Now it says 33. Now down here it says actual unit cost. So now let's go here. This says estimated unit cost. You'll note in the setup that this says the greater of the weighted average of current inventory or purchasing activity. So let's run this. Boom, $33. Okay. So it's seeing, okay, it considered the purchasing activity within the last X number of days, which does not incorporate freight, but it's seeing a higher value in inventory, which over time does incorporate that landed cost. Okay. This will be here. And I don't know if I finished my previous thought. If you're the one charged with administering this, the logs can be a great way for you to exercise oversight. So if you set this up to run every Saturday, you can come in and see which products did the system update this past Saturday. You can look at them and make sure nothing funky is going on until you're confident that your configuration is correct. Okay. So if I reopen the PO, and given time, I'm not going to do it, but if I reopen the PO, that inventory lot would go back to 10, and it would then replace that auto updated cost rate with that $17 value, right? The idea is let's capture the higher of the values, because if we're carrying inventory and we create an order, we are likely to use that inventory before we are going to purchase it new. Okay. Okay. Now I want to talk a little bit, I don't think it's in my notes, use cases. So in our experience, there's kind of a mutually exclusive kind of setup. You're either purchasing something very frequently, at which point, shipping methods may vary, yada, yada, yada. You can build some of this just into your pricing. We take the cost, we double it. That gives us enough buffer for, different shipping methods. If you have this gigantic landed cost because you're buying sand from China, well, then you're carrying inventory because you're not sending containers over every day. So this method, at least for our current customers, works. If someone comes to me and says, we're purchasing this all the time, and therefore we're not carrying inventory, but we do have these landed costs, but they're not associated, like that's not a use case we've seen. If that comes up, we're excited to work with those customers. We're also excited to work with our partners to address that. With that in mind, there is, just so everyone knows, there is a separate cost field under the hood called freight cost that can be put on the interface, that can be edited manually, and that could be updated automatically. But that's not a use case that we've come across. Typically, we're either going to be working from inventory and we do want landed cost, or if we're buying it all the time, we can just key our prices off of the purchase price. Okay, so I'm going to, let's reopen this PO. Like my notes say, we'll move into cost of goods sold. Okay, so now we're back to 10. Okay, now it wants me to rerun this. Okay, I guess this wasn't my notes. So that it goes back to this lower cost. Okay. All right, so we're gonna sell this line. And for expedience sake, we're going to say this is a pickup. Yeah, we'll just sell for $50 for today. Okay. Okay. So when you have a pickup scenario, the payment is what creates the inventory usage. So with cost of goods sold, we have the lot, that's the source of inventory. We have the usage, that's the use of inventory. So let's go over to inventory usage. Here we go. And we can see here, it picked up that $17. This is the placeholder. Okay. Okay. All right, so let's run the COGS process now. This is normally an automated process. We're going to run it manually today. Oh, I'm doing a lot. Well, it's all my WIP stuff. Okay, so let's see, okay, so it's in here. Oh, 4/20/23. It used the $10. Okay, because that's the cost that's coming from the PO. Even I get lost, right? We use this, it said based on the LIFO FIFO logic paired with this PO, $10. So you got this estimated, which is kind of an approximation. Let's say it couldn't find a PO for various reasons. We can talk about that later. It would use that. If it does find a PO, this happened to be a PO with that lower cost. Okay. Now let's close that PO. So I'm going to jump over here. Let's close that PO. Okay. Go back here. Now we see that the cost is 33 because it went from that estimated to boom. Okay, it's done. Everything's there. This actually is the right value. So if we run the COGS process again, it picks up the difference. So this is really important. We're doing lots of things. We're doing lots of things. We're doing lots of things. ACE is putting the costs, the true costs associated with the real transactions, that PO. We don't do standard or average costing. We do true costing. It's putting it onto the books. And then if a freight bill comes in or something occurs that changes the cost, that'll go on the books with the difference. right? So that typically we're not buying sand from China where we've got this gigantic like shipping rate, but then the low value. So in the real world, it's something like, okay, we bought it, the freight came in yesterday and it adds a cent or two. And so you get sort of this adjustment for the landed cost. But you can see these are the real values associated with that actual PO based on that actual freight invoice. And this gives you an idea of what the cost of goods sold system does. It's pairing usage with POs. The POs are taking into account all of the real values. Okay. All right, so now let's go into WIP. Okay, orders, let's come to our WIP example. Okay, so here we are. So yesterday I went ahead and I created this, and I put some job costs and some revenue and things like that on the books. So let me just go to all job costs. Okay, sort by date. All right, so this particular order has an estimated cost of 1,100 and change, almost 1,200. If I run the WIP as of, let me do it this way, 4.3, let's run this WIP. What did I do? Maybe I entered 30 or something. It says, okay, the estimated revenue for this order is this, the estimated cost of this, the recognized cost, that's these guys, are this, percent complete, 34%. So we are entitled to, we have accrued, we've earned $944 in revenue, even though we haven't invoiced for it. Let me run this again with April 10th in mind. Okay. So now we see recognized costs are 572. So now our earned revenue is moving up, right? So now let me do the 15. Okay, boom, 70%. But we sent them an invoice on the 15th for what we had worked. So we had recognized for almost all of what we'd worked. We then recognized 1575. So our WIP adjustment now is 368. So what the WIP adjustment is it takes the revenue that we've earned based on percent complete, compares it to what we've invoiced, and it gives us the difference. That way we can see whether we've earned revenue that's not currently on our books, or whether we've billed for revenue that we haven't currently earned. So we, for example, we bill a 50-hour service block, but we haven't worked 50 hours. So that revenue is not actually real revenue. If we've worked 25 of the 50 hours, then now we're entitled to half of that revenue. And that's where you get into conversations about deposits and things like that. But that's the idea behind the WIP report. We do not do these WIP adjustments automatically. Our customers, usually they only care about this on like a quarterly basis, maybe a monthly basis. They look at the report. I guarantee you, they always say, well, you know, this order is a little bit different. We're gonna make an exception, etc. We have had one or two clients who say, no, you know, automate this and have it create a general journal entry. And so we can do that. It's just, usually the results aren't right, because in the real world, just like with a PO, it's just not that clean. Systems that try to do all of the accounting for WIP end up with the GL that just explodes. It just explodes. You've got like millions of entries, and then you can't audit it, etc. So we think right now we've got the best of both worlds for our customers. We're not blowing up people's general ledgers, and I'm going to show you how that gets complicated here in a second. We're also not we're also giving the tools they need to just say, well, yeah, here's what the system thinks. We're going to adjust it for these ways because we happen to know that this or that is not accurate. Percent complete, for example, is sometimes not an accurate reflection of a job's completion. Imagine, you bill drills with diamond tips. You might buy that diamond tip and that order might be 90% complete from a cost perspective, but you haven't spent 5 minutes. So there are plenty of scenarios where those numbers just quite don't jive, and some human intervention is required. So we think we're treading that line quite well right now. Okay, so let's now go to this order. And I think I can actually just go here. And let's add my cameras. Okay. Let's add our new code. Oh, yeah, it's this guy. Okay. All right. So let's look at this for a second. Let's talk about it. This came in at 17 bucks, right? Because that's this value. Had I added it to the order, we'd see that same value, 17 bucks, going right back to where we started. This may be the value that you want to use for inventory. Perhaps you have given your salespeople pricing flexibility, increase the price here, decrease the price there. What we're trying to achieve is a margin. And you say to me, I don't want to punish that salesperson because of LIFO or FIFO. That would be unfair. Two salespeople issue the same quote with the same margin based on LIFO or FIFO. One gets a lower cost and a higher commission than the other. No, we want to, for inventory, use these estimated costs. There's a lot more control there, but we still want to compensate them based on actuals, but put actuals in quotes, right? These are the conversations that we have with customers during the discovery process, and oftentimes not even during the discovery process, sort of after they go live, because these are very advanced topics. Another customer may come to me and say, we don't want to use this cost. We do actually want to see how accurate we were estimating vis-a-vis the true cost. And we want that to consider landed cost. And we want that to consider LIFO and FIFO. That's not how we're compensating our people. So this, as we saw earlier, created a usage. Yeah, there it is. Right. So if let me see. Okay. So we have a preference over here. I think it's in accounting preferences. Yep. Do you want to update job costs with the inventory actual cost? If this is left off, it leaves that job cost at 17 bucks. $17 is what's going to show up on our WIP report. That WIP number and that percent of cost completion, they jive. So now we got an accurate percent of cost to date. Okay. If I turn this on though, it updates the job cost with the true cost, which is in this case, as we saw, a much higher cost. That keeps the job cost ledger much more in sync with the GL, gives us certain benefits from an accounting perspective, but now our cost to date percentage starts to get a little funky, potentially. So I'm going to go ahead and just turn this on. We'll hit save. Let's go to this usage. Okay, here it is, the job. Let me just sort of force this process this aspect of the COGS process through. Boom, unit cost of 33. And there she is, 33 bucks. And if we look at the logs, we can see exactly where that change occurred. So, you know, one of my favorite quotes in life is from Thomas Sowell. He said, favorite quotes, and I'm blanking, but basically that everything in life is just trade-offs. There's no sort of right or wrong. It's just trade-offs, and that's what you're seeing here. Which aspects of these tools you implement, right, really depends on you, your company, and how you're managing your business. But there's a lot of power here, and so you can use it, you can not use it. You can leave that auto update process off. You can do things manually. You can even in aACE use it, you know, have aACE be a standard or an average cost system. You just don't, we have an accrued cost system rather than the cost of goods sold system that uses the estimated rate. So lots of power, lots of functionality. Hopefully these 50 minutes so far have answered some of the questions regarding these particular features that came up in the last webinar, which obviously was foundational, A, and you can tell none of this is foundational, and B, we just didn't have the time to adequately address. So I want to stop for a second and see if we've had any questions, or if this is one of those webinars where people are going to watch the recording and pause and follow along. And if we haven't had questions and I have some time, I want to talk about 2 more of the things that came up in the previous inventory webinar.
No questions. So it looks like
Probably
you have
recording watching.
looks like you have some more time.
It's intense.
Cool. Yeah. I will say though, this is why people buy aACE. People buy aACE because they come to us and they're like, we have no idea what our inventory is. We really have no idea whether we're making money on anything. What you see here are all real numbers. You saw a job cost being submitted for an inventory item and it going back to that PO, which may have had, you know, interesting sort of freight costs, and getting the actual cost. And that's just something you're not going to get in a lot of the smaller solutions. You get that sort of thing in some of the larger solutions, but sometimes it can be more complex because the assumption there is we've got a larger team, right? And so that brings me back to that sort of WIP conversation where there's a line where our customers have outgrown the simple solutions and they need to get a better handle on things, but they also don't have teams of people looking, reviewing, adjusting. They don't have committee meetings, you know, to determine the percent completion of particular orders, things of that sort. So they need to run fast, but they also need more automations than some of the other systems permit. Okay, so let me answer a question from last time. And the person who asked this, I believe, submitted a support ticket this morning. I saw it right before coming into this webinar about needing to adjust inventory balances and which record type to use. So the question last time was, let me go to inventory adjustments. Okay, we know a beginning balance that adds inventory, that creates an inventory lot. What is account doing? So account creates inventory usage records. That's the short answer. So let's say, for example, that we go live with aACE, we put 10 in the system as our beginning balance, right? And so that debit to inventory is a credit somewhere else, an equity account typically for beginning balances. So we got 10. And someone a week later counts 8. That creates an inventory usage for 2. To usually like an inventory losses account. Maybe 2 were out in the rain, they got damaged. Maybe the person just actually only counts 8. Someone stole 2. I mean, whatever the case may be. Originally we had 10, we counted 8. The next count though, they count 10. So the previous count was erroneous. And maybe it was just erroneous because someone moved the boxes underneath a table because they wanted to make extra space for the forklift to go through. Like, this is the kind of stuff that happens in the real world. Well, if that initial -2 created an expense, then that subsequent +2 needs to create a negative expense because you want to end up at the same place. So the answer to the question last time is that an account creates a usage. Usage can be positive or usage can be negative. Someone goes into job costs and they say, I used this, and then they say, oh, whoops, I didn't, and they put in a negative value, right? That's a negative usage. It didn't really happen. So that's how counts interact with the cost of goods sold engine. The other thing I wanted to talk about here, since I have a couple minutes, I will. Let's go back to that PO from today. No, I didn't date it today. It was 3/20/23 Ford Granger.
And we do have a question, Michael. So.
Okay, let me just finish setting up here so I can hopefully demo this one feature, but I'll take the question first.
Okay.
I'm gonna void out. Was it this guy? My last one. Okay, cool. All right, I'll take the questions. If I don't have to, I do have to run a couple minutes before the hour. If I don't have time to demo this feature, then another time. Questions?
Yes, it is. How do counts interact if you have multiple lots?
So you're counting, right, products for location, and there's adjustments. The cost of goods sold process is what chooses the lot. So if it's a serialized item or a manufacturer lot tracked item, like you have an ID for the specific unit, it's going to choose the lot associated with that unit. We know that unit, 1189 came from this particular PO and had this exact cost. Otherwise, it chooses based on LIFO and FIFO. What was the other question?
That's it.
Okay, so let me show this feature. So pretend this is our last invoice or one of our invoices from the PO, and Granger is billing us for freight. So this invoice corresponds with the shipment of these exact units. They're billing us for freight. This is where we can put in $150 and we can choose how to allocate it, and we press the OK button rather than the use PO button. Or maybe it was just so we can see something different, right? Here we can see how it allocated that $50. And if this was, let's just say $18, right? Let's do the same thing based on value. You can see it's giving us some more interesting numbers. So that's how, if you get an invoice from a supplier for the goods, they include a shipping charge, they shipped it to you. That's really the norm. That sort of carrier scenario really is only applicable to a subset of our customers. None of whom have gone live yet, so I'm glad we caught that vendor bug earlier. But this is really the norm, and you can put the values in there. And this is how it gets allocated. If it's a separate freight invoice, that's when you're using the PO, like we saw earlier, as the point of reference. And typically there you do get one bill for the entire PO, but and you can create one purchase for multiple POs. So we have a lot of scenarios where someone's sending lots of POs to a supplier, but then a bunch of them just come on the same container, right? It still works. That might be an example where you have a freight purchase spanning multiple POs and you want to allocate everything across. Cool stuff. And just per what I said earlier, a lot of times this is the stuff you roll out even after go live, because it's just kind of a little bit too much to get done on the front end of a go live, but we're proud of that. We're proud of the fact that aACE is easy to implement, but then when a customer starts wanting to tackle these problems, we've got some solutions in place for them. Okay, that's all I got.
Awesome.
Perfect.
Was that enough?
Yeah.
Talk about
Digest
happy hour.
that. Yeah, we'll let everyone digest that and see if there are any questions come through email. Yeah, go ahead and see.
I'm good. I got to get going here, so I'll let you.
Okay, we'll
or
wrap
outro.
up. Yeah. So that's all for today, but we hope to see you next Thursday at 11 a.m. Eastern when we continue our Discovery Track series. Before we wrap up, I'd like to thank all of you for attending and for sharing your questions. You will get a link to this recording so you can watch it again or share it with colleagues who weren't able to join us today. If you think of any questions that we did not cover, you can always reach out to us at sales@acesoft.com and we'll be happy to get you an answer. You can also sign up for future webinars at acesoft.com/webinars. Thanks again, everyone, and enjoy the rest of your week.
Bye, everyone.